Good afternoon and welcome to Chartered Mind Academy. So today we'll be looking at IAS 23 borrowing cost. Borrowing cost was revised in 2007 and that revision eliminated what we call the option to expense or borrowing cost. What this here means is this. So before 2007, so we have IAS. There's borrowing cost. Before 2007, when the previous accounting treatment of IAS 22 was what was revised, we were having benchmark or the tradition or the traditional way of what of reporting traditional treatment of what of borrowing cost before the revision. This is how borrowing cost what is treated. What this means here is this, that when company example takes loan of 100,000 at 10%, so under the traditional treatment of borrowing cost, this is how it is treated. So you will have what your principal, which is 100,000, then you charge what interest of what 10% on it. So what do we have here? So when we charge 10% on it, on this one, you will have what interest of how much? Or have interest of what 10,000. So this is what interest, and this interest is what is expense through what P&L. So this is what expense through what profit and loss account, which is 10,000. So this is what we call the benchmark or traditional treatment of what of borrowing cost. However, after 2007, after the revision, which was what 2007, the borrowing cost treatment changed to what? It is now what allow what alternative treatment. All right. So under the allow alternative treatment, all the borrowing cost what is capitalized what to the cost of what of the loan. So example, if you have what the loan, which is what 100,000 at what at 10%. So when we charge the interest will be what 100,000 times what times 10%. So that gives you what 10,000. So now this interest what it capitalized what to the loan acquired. So you will have your loan, which is what 100,000. Then you add the interest, which is what 10,000. So in all, the total loan acquired for the building is what 10,000. So this was a capitalization of what of interest or to the loan. So these are the what are the treatment before and after the what after the method or after the revision of what of the standard. All right, so let's go into the what into the more detail to the standard. Okay, the borrowing cost must be capitalized as part of the cost that the asset. So the other borrowing costs are expenses on the period that they incurred. So that's the primary comment about the standard. So let's look at the key definition. We have borrowing cost and we have qualifying assets. So when we say borrowing cost is what I demonstrated earlier, that when you borrow, the interest that accompanied it is what we call the borrowing cost. And that borrowing cost is what is capitalized to the what to the loan acquired. Now we also have what we call qualifying assets. When we say qualifying assets, what do you mean by qualifying assets? Qualifying asset is what is when it takes a substantial time to what to develop an asset. That's what you call what qualifying asset. That is what this means here. So when we say qualifying asset, what do you mean by qualifying asset? So now you're talking about what qualifying asset. Now the qualifying asset, what do you mean by the qualifying asset is what is when it takes a substantial period to develop what an asset, right? Okay, substantial period to develop. So when it takes what substantial period to develop and what to develop an asset and what and bring it what to the what bring it what to use. What this here means is this. So before an asset can qualify as what as a qualifying asset and you can apply the borrowing cost, what it should take a period of time to develop an asset, which means when you go for a loan, and buy an asset, it doesn't qualify under borrowing cost. So you took a loan and you acquire an asset, it doesn't qualify under borrowing cost. However, when you take a loan and you use the loan to build an asset, we call it a qualifier. So that means you take a substantial period to what? To develop this what? Asset. We call it borrowing cost. So for example, so if you have what? You took a loan of 100 million at an interest rate of 5%. What did you use this loan for? You use one to what? Acquire, or you bought an asset. When you do this one, it doesn't qualify. Not qualified. Not qualified under IAS 23. Right? Okay. So when you take a loan of 100 million at interest rate of 5%, and you use one to what? To build an asset over the period. So the period could be 6 months, 1 year. So it should what? It should be a substantial period, right? So when you do this one, they say that it's qualified under IAS 23. This is what we call qualified asset, qualifying assets. Qualifying asset. And this one is qualifying asset because the reason why it becomes qualified asset because the interest charged on the loan will be capitalized on it, so that we can use that on as a basis to determine the measurable value of that asset. So here is it. So if you acquired loan, so this is the loan is 100 million at 5%. So how many years are you going to are going to use how many years? 1 year to build this asset. So it means the loan period you took this loan, the loan period is 3 years. You are going to use 3 years to pay off this loan. So how do you determine that this one is qualified asset? So you are going to use one to build to build an asset for the company. So how do we do it? So if it's going to take you 1 year and nothing interrupted it, so all you have to do is that you take years. So year 1, year 2. Okay, it's going to take you 1 year to build. Good. Now, so let's see. So you have year 1, year 2, and year 3. Okay, so every year you will have 100 million times times 5%. 100 million times 5%. 100 million times 5%. Okay, so this is how it happens. So whatever you get here is what we call the interest that you are going to pay. All right, so the interest year 1 is 5 million, right? Okay, so it is maybe 5,000. Let me hang 3 zeros. So year 2 goes to 5,000. Year 3 goes to 5,000. Okay, so that's the whole accounting year. Okay, right. So now you've taken substantial period to build this asset. Now, when that happens, you took only 1 year to build this asset. So every month you will pay interest on your loan. So when you convert it to yearly, every year you are going to pay 5,000. So here, this is how it is capitalized. So we said that this building that you took loan for, you took loan to build this building. How much? So here, when they ask you to how much did it cost you to build or put up this building, what are you going to say? Right? What are you going to say? All that you have to do is say that you took a loan of 100 million. Let me hang 3 zeros. You took a loan of 100 million plus the interest year 1 year, because it took you only 1 year to build this building for the company. And how much is the interest? 5,000 or 5 million. So when you add it, it will give you this is how is what is going to give you. So when they ask you how much did it cost you to put up this building, then you can say that it took you the fair value or the value of this building is 105 million in your statement of financial position. So we've capitalized the interest added to the principal loan that you took, then that is what the cost of the building, because you took the loan purposely for the acquisition or building putting up the building. So this is the cost of the building, and this is going to sit in your books as the value of the building. Good. And remember, the loan is 3-year loan. So at the end of the day, you've already had all that you needed from from the loan by putting up the building within 1 year. So now the building is now available for use, right? So at the end of the day, all you have to do is that if it's completed 1 year, then how much did you take the loan? Then you add the interest to it. However, it took only 1 year. The loan is also 3 years. So if so, then what happens to the rest of the loan interest? What happens to the rest of the loan interest? So the rest of the loan interest, you do what? You take it to profit and loss account. So you go and You go and then expense it. So you realize your interest. So year 2, and then year 3, you expense all those interest in your profit and loss account. All right. So this is what we call the qualifying assets. All right. So let's get back. So now that we've understood the qualifying, let us look at some of the assets that qualifies to be capitalized. We have for property being constructed for own use. So when the company is building a property for its own use, is a qualifying asset. Manufacturing plant under construction. You have for power generation. You see, all these assets takes substantial period to build. Investment property under construction. All right, so investment, so it means the company is putting up a building for rent. That's what we call investment property. Biological asset, that takes a substantial period to measure. This is IAS 41. So in here, the company is having a biological asset. It could be a farm. It could be a rearing of animal, right? Farm, produce, and so on and so forth. So all those assets takes time to build. If it is a rearing of animal, it takes you many months for you to build those animal, or you bring them to be at the point that the company put them either under the asset, or under parent asset, where these animals are readily available for sale. And you also have inventory that requires substantial period to bring to saleable condition. All right. Now the assets that are not qualified are they are assets manufactured in larger quantity on a repetitive basis, short production cycle. So when you have the product the company produces for sale, right? So maybe if the company is producing soap, so this soap is a repetitive. They produce, they sell, they restock. So those ones don't qualify as a qualifying asset. Assets that are also ready for intended use when acquired. So as earlier indicated, when an asset is loan was acquired and then just went and bought an asset. No. And we have financial assets, and your investments, financial investments, and so on and so forth are also not a qualifying asset. Inventory that takes shorter time period, as earlier explained. Okay, now let us look at commencement, suspension, and cessation period. Now, all three conditions must be met. Very, very important. So the commencement, expenditure on the asset are okay. So let's look at the commencement. First one, let's look at the commencement before you can you can make a decision that, okay, now I can capitalize on this borrowing cost. The commencement is very important. So let's look at commencement. Now, when we pick the commencement, so you have commencement. Now, at which point do we capitalize on borrowing cost and say that, okay, this is now the value that I can place on this asset. So, example, if you took a loan, so 1st January 2024, you took a loan of how much? A loan of 500,000 at 10% interest rate. The purpose of this loan is build a factory. This is when you took the loan. And when did you commence what? When did you commence the building? The commencement of what? Of putting up the building is when you commence putting out the building on 1st May 2024. Very, very important here. All right, so this is what we call the commencement of what? Of the period. So when do we start saying that, okay, let me capitalize the borrowing cost? You took the loan on 1st January 2024, but you started using the what? This loan on 1st May 2024. That's what we call commencement. So at which when do we what? Do we say that we can now capitalize on this loan and then asset, measure of the value of what? Of the asset. So what this? The purpose of the loan is what? Is to build a factory. So, and it's going to take you how many years? Period. It's going to take you maybe 2 years to build this factory. You see, so now what do we do here? When you are confronted with something like that, the commencement date, so you look at it that from 1st January. So you look at it that from 1st January 2024 to 1st May 2024, the loan was what? Was idle. This is what we call idle period. This is what we call idle period. So between 1st January to May, this money was not in use. And remember, you pay interest on the loan, right? So you see that the interest between this period you pay. So you have what? 500,000 times what? Times 10%, which is how much? Which is 50,000 per year. 50,000 per year multiplied by how many months? 1st January to May. So January, February, March, April, 4 months. So this 4 months, this money was what? Was not in use. So this 4 months, within that accounting year, this very 4 months, what happens to it? This interest, you cannot capitalize this interest as what? You can't capitalize this interest. So what do? So when you calculate this 500,000, you will get how much? You will get 1,66666. Right, this is how much you are going to get. So this is what 4-month interest, and this 4-month interest what will be expense. You see, you will expense this one in what? In the profit and loss account. You will expense it what? In the P&L straight away. Now, when did the company begin using the money? The company started using the money from what? From 1st May. So between 1st May 2024 to 31st December, if accounting year ends in 31st December 2024, how many months? This is how many months? 8 months period. For the first accounting year, you can only capitalize interest of what? Of 8 months, right? So here, how do you? Either you pick the 500,000 minus 1,666, or you will pick what? 500,000 times what? Times 8/12. So whatever you get, that is how much we can capitalize for year 1. So you realize that year 1, the interest to be paid is 1,133. So this is what the interest. So this is the interest that you capitalize. So here you capitalize. So year 1, you realize that you have what? Your principal. How much the principal? So the principal is what? 500,000 plus the interest of what? 333. So year 1, this is how your what? Your asset value what will be. This is how your asset value is going to look like in your book. So that's what we call commencement date. So when are you commencing and when are you capitalizing the interest or to the loan to form part of the value of what? Of the asset. So that's what we call the commencement date. So here 1, expenditure on the asset are being incurred. So expenditure of the assets are being what? Incurred. Before you can calculate this interest and add it to the principal to form part of what? Of the value of what? Of the asset. So that is when you will start. So here, so when you look at the first 4 months, the expenditure of the asset has not been incurred yet because the money was sitting idle. If the money is sitting idle, with that period, you will expense it in the P&L. So when you start using the loan to build assets, that's what's called expenditure of the asset are being. So at that moment, every interest will be capitalized to the loan that you took. Okay. 2, borrowing costs are being incurred. So 2 is what? Borrowing costs are being incurred. So at this moment, this money that you took the loan, right? This money that you took as a loan, every month you pay interest on it. The moment the period kicks in for you to start paying interest on that loan, it forms part of what? It forms part of the cost of the loan. So for that, you have to capitalize it. So 2, the borrowing cost is being incurred. So when you take a loan, when maybe they give you a grace period of 1 month, the subsequent month you have to start paying the cost of of the loan. So when that starts reading, or when that starts affecting the loan that you took, you need to capitalize it if it qualifies under IAS 23. And then the last one is what? Activities necessary to prepare the asset for intended use. So the last one is what? Activities. Right? Activity necessary what? To prepare the asset for intended use. So what this here means is this. So when you take a loan, and what is it? So intention is that you want to build what? A factory. So if you want to build a factory, what are the necessary preparation ahead? So one of them could be acquisition of what? Acquisition of land. So when that also starts, you can start capitalizing the interest to the loan. Acquisition of of land, right? Maybe paperwork on the land, buying of of building material, buying of building materials. So these are some of the preparatory activities necessary to bring the project into life. So all this, when they start, you can start calculating the for the borrowing cost. So here, so these are the 3 commencement conditions that must be met before the borrowing cost can be capitalized. Now let us look at what we call suspension. So we have suspension. Now, when we say suspension, what is suspension? Suspension is a situation where the company has started working. So, for example, so if there's a commencement of the project is when. So the commencement of the project was 1st January 2024, and then there is accounting year also ended. Maybe you are accounting for maybe 2024. All right, so accounting year was maybe 31st December every year. Okay, so maybe 2024 in that instance. Okay, so if so, what happens in between this period? What happens if the company started from 1st January? They started work of 1st January 2024 to accounting year 31st December 2024. Between this period, we have something called suspension. If it happens, what happens to the calculation of our interest on the loan? Now, if maybe on this period, maybe let me say on 31st March 2024, something happened. What happened? 31st March to 31st March to 31st May 2024. Should something happen? Example, what happened? What happened between this period is workers going on strike. How many months did they go on strike? They went on strike on what? They went on strike for how many months? 2 months. Now, so they went on strike for 2 months, and then they resumed work on 31st May 2024. So they also worked up to this period. So they also worked up to October. So 1st October 2024 to when? To 31st October 2024. So what happened between this period? This period is what? Is for 2 weeks, 2 weeks for inspection of what? Of the project, and then 2 weeks for rainfall obstruction. So these two events also happen between this period. So in all, you will realize this. You will realize it in what? For the period of what? 12 months. For the period of 12 months, you realize that for 12 months, 2 months for what? For strike, and then 1 month for project routine interruption. Okay, so these are what happened. So in all, you will have actual work that went into the project to be 9 months. So what do you do when you are confronted with this situation? We call it suspension. Good. Now, let me take the first 2 months, which is what? Workers going on strike. Now, under the workers going on strike, the first 2 months that the workers went on strike. So one, strike. The strike took how many months? 2 months. Now, when the company faced with this disruption, this is not routine interruption. This is not what? Routine interruption. So if this is not routine interruption, which is the too much of workers going on strike, you do what? You suspend capitalization. And then when you pick the what? The project routine, which is 1 month, it is normal interruption. So what? Capitalize or interest. Here's the explanation. So what this means is that there are certain activities that are avoidable by the owners of the project. So some of them are maybe strike. Let me put it this way: avoidable. Example of avoidable what? Interruption. Example one: strike of what? Of workers. Two, you also have maybe non-compliance of what? Non-compliance of what? Of regulations. There are some regulations that you have to comply before you start. You didn't comply all those things and you started building. When there's an interruption, you suspend what? You suspend the capitalization, but rather expense it in what? In the P&L. So strike, non-compliance of regulation. So when you are not complying with regulation, you can be asked to stop the work. Let me so broadly, these two can also cause the what? Cause the project to stop. Right. So now let's look at what? Routine interruption. The routine interruption, what do we have here? One of them is what? Is when the company what? Inspection of what? Of the project. When you break for inspection, it's what? Is a normal routine. So you capitalize the interest, right? So, and also natural disaster. Example is like what? The rainfall, or maybe flood causing this, or maybe earthquake. So all these ones can interrupt what? The project. So when these occur, it's a natural or routine interruption. So you can continue capitalizing what? Capitalizing your interest, right? So in here, how do you? So you have what? A loan. Example, you have loan of 500,000 at what? At interest of what? 10%. Now the commencement of what? Of the project started from when? 3rd January 2024. Now, along the line, there's what we call suspension. Okay, so suspension 1 from first or I. The first one we call it what? 31st March to May. So you have for suspension, which is what? Strike, and happens when? 31st March 2024 to 31st May 2024. And then second suspension is what? Rainfall. That happens from when? 2 weeks. So let me say 1st October 2024 to 15th October 2024. And then 3 is what? Is inspection of what? Of the project. The inspection takes place from 16th October 2024 to what? 31st October 2024. Right. So this is what these are the events that happen in between. Now the accounting year or maybe required determine what? Borrowing cost a lot of the project as at 31st December 2024. Okay, so this is what you have. So what do you do? So you will have it here. Solution. We have what? The loan. The loan is 500,000. And then the interest on the loan is what? 10%. The company commencement of this is what? 1st January 2024. Now, there are suspensions. So the suspensions are in between. First one is strike. And the strike happened from what? From 31st March to 2024 to 31st May 2024. How many months? There's what? 2 months in there. And we have also what? Routine interruption, which happened between what? 1st October to what? To the 1st October 2024, which is what? 1 month. So as I earlier indicated, some of the months are what? Are not natural, others are also what? Natural. So here, the avoidable or non-capitalization suspension is what? Is a 2 months, which is what? Which is a strike. So in this our what? In this our conversation here, 2 months will be what? We will not capitalize 2 months interest. Right. So how many months do we have? We'll have what? 8 months. Or we have what? 10 months to go. Okay. And we have what? 1 month, which is what? Which is for suspension, which is what? Routine interruption. So routine interruption, nothing will affect the routine interruption. So this is how you calculate your capitalization. That's how you calculate your borrowing cost. So you will have it here. You have what? Your loan, 500,000. Your interest. How much do you calculate? So you have what? Your interest to what? To be 500,000 multiplied by the interest is how much? 10%. Then you multiply by how many months are left that can be capitalized. It's 10%. It's 10 months, 10 over 12. So what do you have for your interest? So you will have what? Interest to be capitalized for the 10 months to what? To be 41667. Good. So this becomes what? Your interest will to be capitalized for the first year. Right. So if you want to know the what? The total cost of the project for 2024, you will just add it. That gives you how much? 541,667. 2024. This is how the calculation is going to be. And now the suspension, the strike period. The strike period, you have what? 500,000 times what? 2 months times 10%. Okay, how do you have? So you'll have what? 8333. All right, so this 833, which is outside the capitalization criteria, then you what? You expense it with profit and loss account. All right, so this is how the suspension is what is determined. This is how the suspension is what is determined. All right, now let us look at cessation. When we say cessation, what is cessation? Now, cessation is a what? Is when the company is brought to its what intended use, then you cease doing the capitalizing. That's what called cessation. So here, example, if you have a loan of what 500,000 at what at 10%. Now the loan was what was to use what to acquire building. So they said that they should commence the building. The commencement of the building is what 1st January 2024, and the period to use what to do this building is how many years? 3 years. All right. So they agreed that the building what completion of what of this building is going to go 2 years. So here the completion will be for 2026 in this instance. So then that means what happens? So the completion date is what we call what? The cessation period. So when when the asset is completed and then handed over, you cease doing what? Doing the capitalization. All right. So how is it done? So when we pick 2024, end of 2024, you will have your loan 500,000. The interest on the loan 10%. You will have what? You will have 50,000 if there's no interruption. So this is what the interest to be paid for 2024. Then you come to 2025. You pick your loan 500,000. The interest on loan is 10%. So you will have what? 50,000 as the loan. So you realize that they said that the asset what is the completion period is 2 years. So we've done the 2 year, 1 year, two. We've done 2 years on the calculation. So you realize that you will have what our loan will to be 500,000, and then the total interest will to be capitalized will be how much? It will be 500,000 plus 500,000, or 50,000 plus 50,000. Okay, so 50,000 plus 50,000 will give you 100,000. So give us what? 100,000. So we've capitalized the interest. So that gives us how many? 600,000. So this is the cost of what? Of the project. So this becomes our cost of what? Of the project is 600,000. Now we have the loan term is what? So the loan term is what? 3 years. We've done what? 2 years. And when we are done with 2 years, we cease what? Doing the capitalization. That's what called cessation period. So you cease doing the capitalization. So remember, the loan, we've not finished paying it. We have what? 1 year left. So after cessation, what happens to the interest? After cessation, what happens to the interest? The interest is what? It's expense of the profit and loss. So you realize that 2026, which is the final year to finish paying the loan, you have what? Our loan 500,000, and then we have our interest to what? To be 10% of it. That gives us what? 50,000. So this 50,000, you take it off your profit and what? And loss extract. Then you expenses. So this becomes your what? Your finance cost, or what? Your interest, which is what? 50,000. All right. So that is it about cessation period. That is it about cessation period as well. Okay. Now let us look at general and specific loans for projects. General and specific loans for a project. Now let us start with general loans. All right. So with general loans, this is how it goes about. So if maybe you have TK Limited prepares to build a factory at a cost of 300 million. So the company went for a loan from A, ABSA, 200 million at 15% interest rate. B, Fidelity Bank, they went for 100 million at 12% interest rate. The building commenced on 1st February 2024 and expected to be complete on 30th September 2027. Okay, so this is it. So required said that required calculates the borrowing cost to be capitalized in accordance with what IAS 23. So this is what you have here. So how do you deal with this matter? This is what you call general loan purposely for your project. Now, general loan purposely for your project, when you went for a loan for a project where the loan is what is split from a pool, or the project is being funded through a pool of fund. What I mean is that this is the total project cost, which is 300 million. However, this project is being funded not only one source, they are funded through more than one source. So if the sources are more than one, we call it general loans, general borrowing cost. So here, the source to build this factory is not one, it's more than one. So we term it as what? General borrowing cost. So how do you deal with it if the source is what? Is many. So how do you do the so you come here, solution. So first, determine the what? Determine the what? The weighted borrowing cost. In order to determine the borrowing cost, how do we determine the borrowing cost? So one, you have to first pick the what? The loans. The loans you have what? ABSA, which is how much? 200 million, 300 million. You have Fidelity, which is what? 100 million. Then you will have what? You will have your what? Your interest. The interest Fidelity is how much? ABSA is 15 and Fidelity is 12. Okay, so here, let me make this one rate. You have here your rate. You have here your what? Your interest. So this one is what? 15%, and this one is 12%. Okay, well, how do you go about it? So 200,000 times 1.5. Here gives you what? 30,000. Here gives me what? 12,000. So add it here. How do you have? It gives you 42,000. And the total loan is how much? 300,000. So when you are done, then you weight it. So you have a 300,000 by what? 42,000. So the weighting, one of them, then you weight it. So the weighting is what? Is what? Your interest over your what? Over the loan. So here you have your what? Your interest of 42,000 all divided by what? By the loans. Times what? Times 100%. What do you have? That gives me what? 14%. So when you are done, second, so when you are done, how much? So if all 300 million is what? Is expended. If all 300 million is expended for the qualifying asset, then the interest to be calculated on this one will be what? 300,000 times what? Times 14%. What do we have? That gives you what? 42,000 interest to be capitalized. This is what you call general borrowing cost. So you have your what? So you want to know if you want. So this is year one. So if you want to know the total as at 2024, you have what? You have your loans, or you have your expenditure or the cost of all report, which is 300,000. Then you have what? Your interest of what? 42,000. When you add it, that gives you the total cost of what? of the project for 2024. So that gives you 34 to for 24. This is what you call the general borrowing cost. Okay. So 2, you also have what you call specific. Now, under the specific is simple. With regard to specific, is what the loans was acquired solely for the project. Example, if TK Limited acquired a loan for a building project, cost of the project is 100 million. A specific loan was what was acquired, which is 80 million at 10% required. Calculate for the borrowing cost to what to be capitalized. So how do we go about it? It's simple. You have what your loan of how much? The loan is 80 million or 80,000. The interest is how much? 10%. So you'll have what? 8,000 interest. Simple. So you have 8,000 interest. If you have 8, what is the cost of the project? So you have what? Project cost of what? 100 million. So which is 100,000. And then you have what? Interest on what? On the project interest. How much did it cost you? On the what? On the loan that you acquired, 8,000. Then you add 8,000 to the what? To the total project cost. So when you add it, you have what? 108,000. So this is what we call specific. This is what we call specific. This is what we call specific interest on what? On borrowing cost. All right. So generally that is it about that. Now let us look at also something in the area of interest income when it comes to borrowing cost. Example, if maybe you have TK took what? A loan to build a factory. The project cost 100 million. Specific loan was 80 million at 10%. The loan was disbursed at the following date. So 1st January 2024, 40 million was disbursed. 1st 2024, 20 million was disbursed. And 1st January 2025, 20 million was disbursed. The project commenced on 1st January 2024. The fund was invested at 5%, bond at 5% required. Calculate borrowing cost to be capitalized. All right, so here, solution. When dealing with what, or when dealing in IAS with the borrowing cost, at a point they can tell you that the fund that you borrowed, not all the money will instantly go into the project. Part of payment of what will be made, the rest of the money will be invested. That's all. So when you look at this question, you realize that they took a loan of 80 million at what? At 10%. And they said that out of this loan, when you make part payment, the rest of it will be invested at what? At 5%. That is the idea here. Now, when we look at it, the payment is staggered into at the 3. So first payment was when the project started, and which is what? 40 million. Now, when you pay 40 million out of 80, how much do you have left? So you have what? 80 minus 40. You have what? 40 million left. So this money will be invested and attract interest. So if we are accounting for us at 2024, then how do we go about it? So we will have it as loan of what? 80 million then you a loan of what 80 million. So the interest on the loan is what 10%. So how much do you have? You will have 8,000. Okay, so you have 8,000 as what as your interest. Then you look at investment. So the investment, what happens to the investment? The investment, remember, they've already in the 1st January, when you look at it as I've written here, so 1st January, they disperse 40 million. So how much left? You will have, you have 40 million left. So watch here. So you have 40 million left. So you have here the total loan disbursed was what? Was 40. The total loan was what? Was 80, and the disbursed was 40. So you have what? 40 remain here. So this 40 is what we call you invest it. So when you invest it, how do you charge? You will have what? The interest what on this amount is going to go to 40 what here? 40 million or 40,000. Then you charge in the question. I said that the interest rate is how much? 5%. But remember, this 40 million, we can only calculate it up to 6 months. Because 6 months, you have to withdraw the money and then make payment, right? Have you seen the next? So you have to calculate it up to the next date that what the new payment was made. So when was the new payment made? The new payment was made on 1st June. All right, so here, how many months? 6 months. So you'll have what? 6 over 12 times 5%. What do I have here? So the interest is how much? So you'll have what? Interest of 1,000. Okay. Now let us look at, the next interest. So the next interest, how much money how much is left? So you'll have your loan disbursed. Remember, earlier we've already disbursed 40. So our next disbursement was when? Our next disbursement was in June. So June we disbursed 20. So you add what 20 to this. So that gives us 60. So what do we see here? You will have 80 minus what 60. You have what 20 left. So 20, this 20 you have left is what you are coming to what? Calculate what your interest again. So you will have what 20 million multiplied by, or 20,000 multiplied by 5% interest. And when is our next payment? Is going to be what? 1st January 2025. So we can calculate it up to the end of the accounting year. Okay, so the next accounting year is 31st. So how many months? 6 months. All right, so you'll have what? Times what? Times 6 over what? Over 12. So when we calculate, what do I have? So that gives me what? 500. So that is it. So the final payment was made in the following accounting year. So that one will not attract any interest. So it will end like that. So when you are done, you realize that you have your what? Your investment interest. So this is what your investment for the accounting year is how much? 500 plus what? Plus 1,000. So that gives me what? 1,500. Good. Then you have your borrowing cost to be capitalized. Borrowing what? Cost for the accounting year. That one is what? Is what I've calculated above here. The interest of what? 8,000. Okay. So you realize that you also have your borrowing cost of what? 8,000. So here, what you will do is that when you pick your what? Your investment interest. Your investment interest to be what? To be 1,500. Then you less, or let me put it this way, you pick your what? Your borrowing cost to be what? To be capitalized, which is what? 8,000. Then you less your what? Your investment interest. Because an interest that has accrued to you through the loan that you attracted, because you invested part of the loan, so it brought in money. So if you are paying interest on the loan and you've also accrued some interest as you invested part of the money, then it will reduce your what? Your interest liability. So when you less it, you have for 6,500. So here, this is how much you are going to capitalize. So you will have your what? Your project costs. how much did it cost you? The project cost is what, 100 million, 100,000. This is how much it's going to cost you for the project, and you took a loan, and the cost, so the borrowing cost to be capitalized is now how much? 6,500. That's all. So you have what? Okay. So that is it. So that is how, when there's also interest what to be accrued when you invest in it. All right. So that is it about that. Thank you very much.